Welcome to The Explainer. I am absolutely thrilled you're here today. All right, let's just dive right into this. I want you to picture this scenario. You finally decide to do the responsible thing. You start saving your money every single month. You move a little bit into your savings account, maybe $100 here, $200 there. And you feel good about it. You know, you're being responsible, disciplined, and financially mature. You are doing exactly what you were taught to do. But then, one day, you open up your banking app and realize something kind of strange.
You look and see that your savings account has $10,000 sitting in it, but it's earning something absolutely tiny, like 0.5% interest. Which means, after an entire year of ironclad discipline, you have made a grand total of $50. $50. I mean, you can barely buy a decent lunch for two with that nowadays. Meanwhile, you keep hearing people around you, or in the news, constantly talking about investing, stocks, index funds, and compound growth. And suddenly, this thought just pops into your head. Wait, am I doing this wrong? Because saving money is inherently good, right? Actually, it's essential. But saving alone rarely builds real wealth. And this is exactly where a lot of people just completely get stuck. They know saving is important, but they have absolutely zero idea how to safely make that leap from saving to investing. They don't want to feel overwhelmed, and they definitely do not want to risk their financial security. So, to guide us through this transition, here's our roadmap for today's explainer. We're going to cover 1. The problem with saving alone. 2. The math behind wealth. 3. Overcoming investing anxiety. 4. The 5-step path. 5. Why boring is better. And finally, 6. Stability versus financial freedom. Let's get right into it.
Starting off with Section 1, the problem with saving alone. Let's dismantle the illusion of safety that comes with just leaving all your cash sitting in the bank.
Let's start with something that might sound a little bit controversial right off the bat. Saving alone will almost never make you wealthy. Look, saving is undeniably important, but it's not the final goal. It is literally just the first stage. And here's why. Savings and investments have two entirely different jobs. Savings protect your money. Investments grow your money. Leaving all your cash in a savings account is honestly like giving it a job it simply wasn't hired to do.
Which brings us right to Section 2, the math behind wealth. Because, well, numbers don't lie, and once you see the math on this, you really can't unsee it.
Imagine you save $10,000 in a standard savings account at 1% interest. After 1 year, you gain $100. Not bad, right? But historically, the S&P 500 stock market returns an average of 10% a year. In that scenario, you make $1,000. But the real magic isn't year one, it's compounding over decades. To put this into perspective, after 20 years, your 1% savings equals barely over $12,000. But that exact same money, invested at 10%, it absolutely rockets to $67,000. So the biggest wealth gap isn't between spenders and savers, it is literally between savers and investors.
So why on earth don't more people invest? Let's explore that in Section 3, Overcoming Investing Anxiety.
The problem actually isn't the math, it's psychology. Saving feels safe, while investing feels risky. When your money sits in the bank, you can see it. It doesn't fluctuate. It doesn't just randomly drop 5% on a Tuesday afternoon. But investments, they move. Sometimes they go up, sometimes they go down, and that emotional roller coaster actively scares people away. You might be sitting there thinking, I don't want to lose my hard-earned savings. And hey, that is a totally fair and valid fear, which is exactly why the transition from saving to investing should happen in stages, definitely not all at once. And that leads us straight into Section 4, the 5-step path. This is how we actually bridge that gap safely.
Here is the systematic solution to transitioning your finances without the total panic. We'll break these down, but the 5 steps are 1. Build an emergency fund. 2. Create mental buckets. 3. Start small. 4. Focus on simple investments. And 5. Commit to consistent investing. Let's look a little closer at those first 2 foundational steps. Step 1 is absolutely non-negotiable. You have got to build a real emergency fund. Before you invest a single dollar, you should have 3 to 6 months of living expenses saved in cash. And this money, it stays in savings. It's not for investing, and it's certainly not for jumping on some hot new stock opportunity your friend told you about. It is exclusively for unexpected problems, things like a sudden job loss, medical emergencies, or surprise car repairs. Because here's the crucial point. The biggest reason people panic sell their investments is simply because they need cash too soon. An emergency fund actually protects your investments from the unexpected events of your own life. Now, step 2 is basically a psychological trick. Mentally separate your saving from your investing. Think of your money as living in 2 totally different buckets.
Bucket 1 is your safety money. It does not move. Bucket 2 is your growth money. This money is allowed to fluctuate because its entire job is to grow over time. Honestly, just establishing this mental separation reduces anxiety so dramatically. It gives you the peace of mind to actually let your investments do their job.
Let's move into Section 5, Why Boring is Better. This covers steps 3, 4, and 5 of our path.
Step 3 is to start small. You don't need thousands of dollars to get going. A lot of platforms let you begin with just 50 or 100 bucks. The goal right now isn't massive profits, it is just building the habit. Step 4 is focusing on simple investments first. Beginners often make the massive mistake of jumping straight into really complicated strategies. Day trading, options, or crypto speculation. But the simplest investments almost always outperform the complicated ones. Take index funds, for example. Instead of trying to pick one winning company, an index fund tracks the overall stock market. You're basically investing in hundreds of companies all at once. It gives you instant diversification, way lower risk, and steady long-term growth. It's simple, and it works. Even legendary investor Warren Buffett repeatedly recommends low-cost index funds for most everyday investors.
And that brings us to Step 5, Consistent Investing. What most people really don't realize is that the absolute most powerful investing strategy is, well, pretty boring. Imagine you invest just $300 a month. If the market averages 8%, after 25 years, you'd be sitting on roughly $285,000. But here's the crazy part. You only contributed $90,000 over those 25 years. That massive leftover chunk, almost $195,000, is pure investment growth. That's compounding, literally doing the heavy lifting for you. It's boring? Sure. It's consistent, but man, it is incredibly effective.
Finally, let's wrap this whole thing up in Section 6, Stability versus Financial Freedom, where we redefine the ultimate goal of managing your money.
Because psychology still matters so much here, you've got to remember that investing can feel uncomfortable at first. Markets go down, news headlines get super dramatic, and naturally, people panic. But this is exactly where discipline separates successful investors from gamblers. Think of saving money like storing seeds in a glass jar. Yes, you are absolutely protecting them, but absolutely nothing is ever going to grow in there. Investing, on the other hand, is taking those seeds and planting them in the dirt. At first, it looks messy. You don't see results immediately. But give it time, let things grow, and eventually you have something far, far bigger than the original seeds you started with.
Now, you might be sitting there thinking, okay, but what if I start planting my seeds and the entire market crashes? And honestly, that is a great question, because market crashes are completely normal. They've happened dozens of times throughout history. But here is the absolute key insight you should take away from this explainer today. Long-term investors actually benefit from those downturns. Think about it. When markets drop, your consistent monthly investments are just buying more shares at lower discounted prices, and that almost always leads to stronger returns when the markets inevitably recover. This is exactly why experienced investors stay so calm during volatility. They aren't thinking in days, they